Most people wait 40 years to collect dividends. Harry figured out how to get paid every single month starting with just $5,000. While everyone else is chasing the next hot stock, Harry's collecting dividend checks like clockwork every single month. And here's what nobody tells you about dividend investing. You don't need $1 million to start building passive income streams that could pay you forever. See, Harry discovered something that changed everything. Instead of buying individual dividend stocks and hoping they don't cut their payouts, he found 5 specific ETFs that transformed his investment portfolio into a perpetual income machine. One of them pays 10.75% annually. That's not a typo. But before you think this is another get-rich-quick scheme, let me be clear. This is about building long-term wealth through a systematic approach to dividend ETFs. This isn't financial advice, just education about what's possible with the right strategy. All investments carry risk. Here's what we're uncovering today. First, the high-yield ETFs most investors have never heard of. Then, the hidden gems from Goldman Sachs. And finally, the rock-solid foundation that's increased its dividend for 13 straight years. Because here's the reality nobody wants to admit. Most dividend investors are doing it completely wrong. They buy random high-yield stocks, watch them cut dividends, panic sell, start over. It's exhausting. Harry was stuck in that same cycle until he discovered the power of dividend ETFs. See, when you buy a single dividend stock, you're betting on one company's financial planning. When you buy a dividend ETF, you're buying a basket of dividend-paying companies, managed by professionals, rebalanced automatically. It's the difference between putting all your eggs in one basket versus having multiple baskets carried by experts. But not all dividend ETFs are created equal. The first mistake Harry used to make, chasing the highest yield without understanding what drives sustainable dividend growth. That's like buying a house because it has the cheapest rent, ignoring that it's falling apart. So Harry develops a 3-pillar system. Pillar 1, yield acceleration. Pillar 2, strategic diversification. Pillar 3, rock-solid foundation. And it starts with something most financial advisors won't even mention because Wall Street keeps it quiet. There's a strategy institutions use to generate extra income from stocks they already own. It's called covered calls. And when ETFs use this strategy, something magical happens to the yield. Harry discovered this when he stumbled upon an ETF yielding 8.40%. But that wasn't even the highest. See, most investors think you have to choose between high yield and safety. That's outdated thinking. The new generation of income ETFs uses option strategies to juice returns while maintaining asset allocation discipline. Enter JEPI, JP Morgan Equity Premium Income ETF. 8.40% yield, paid monthly. Let that sink in. Monthly payments instead of waiting every quarter. JEPI holds quality companies like Microsoft, Amazon, and MasterCard. But here's the kicker. It writes covered calls on these positions to generate extra income. It's like renting out rooms in houses you already own. Harry allocated $15,000 to JEPI. At 8.40% annually, that's $1,260 per year, or $105 every single month. But Harry wasn't done, because if JEPI targets the S&P 500 companies, what about the NASDAQ? What about all those tech giants? That's when Harry found something extraordinary. GPIQ, JP Morgan's NASDAQ-focused income ETF. This is where the story gets crazy. 10.75% yield. That's not a misprint. GPIQ yields 10.75% annually, paid monthly. It holds the tech titans. Nvidia at 8.44% of the fund, Microsoft at 7.14%, Apple at 6.57%. These aren't risky startups. These are the companies powering the global economy, wrapped in an income-generating strategy. Harry put $15,000 into JEPQ. At 10.75%, that's $1,612.50 per year. Another $134 hitting his account every month. But here's what most people miss about these high-yield ETFs. They think high yield means high risk. Not necessarily. GPIQ has returned 8.71% year-to-date in total returns. That's appreciation plus dividends. It's not just paying you income, it's growing your investment strategy simultaneously. The dividend growth is even more impressive. 19.58% year over year. Your income stream is growing faster than inflation. Now, you might be thinking Harry's portfolio is complete. High yield with JEPI and GPIQ. What else could you need? That's when Harry discovered what the smart money was doing. Goldman Sachs, one of Wall Street's most prestigious names, quietly launched their own income ETFs. Lower fees than JP Morgan's offerings. Similar strategies, but with a twist. GPIQ, Goldman Sachs Nasdaq 100 Premium Income ETF, 9.81% yield, 0.29% expense ratio. That's cheaper than JP Morgan's 0.35%. Harry noticed something interesting. GPIQ returned 14.26% year-to-date total returns, outperforming GPQ despite a slightly lower yield. Sometimes in wealth building, it's not just about the highest number, it's about total return, growth plus income. And the dividend growth? 26.30% this year. That's explosive income growth. Harry allocated $10,000 to GPIQ, adding another $981 annually to his income stream. But there was one more piece to Harry's high-yield puzzle. GPIX, Goldman Sachs S&P 500 Premium Income ETF, 8.07% yield, same 0.29% expense ratio. But here's the kicker. 11.55% year-to-date total return. GPX owns the entire S&P 500 while generating premium income. It's like JEPI's cousin, but with Goldman's approach to money management. Harry's next $10,000 went into GPX, another $807 annually. At this point, Harry had built an incredible income machine. 4 ETFs, all paying monthly, yields ranging from 8.07% to 10.75%. But something was missing. These covered call ETFs are relatively new. GPQ launched in 2022. GPIQ and GPIX are even newer. We don't have 20-year track records. Harry needed a foundation, something rock solid, something that had proven itself through recessions, pandemics, and market crashes. Think about this for a second. What if you could own pieces of companies like Home Depot, Chevron, and Pepsi, all in one fund? Companies that have not just paid dividends but increased them year after year. That's when Harry discovered SCHD, the Schwab US Dividend Equity ETF. Harry calls it his foundation because while everyone's obsessing over yields, SCHD focuses on quality, 3.73% yield. But here's the real kicker, 0.06% expense ratio. That's practically free. It means you keep more of your money working for you in your retirement savings. But here's what makes SCHD special. It's increased its dividend for 13 consecutive years. Through everything the market has thrown at it. The dividend growth rate, 8.58% annually. Your income grows steadily, reliably, forever. When Harry put $20,000 into SCHD, he wasn't chasing quick gains. He was building a foundation that could withstand anything. Now let's do the math on Harry's complete portfolio. $15,000 in JEPI at 8.40% is equal to $1,260 annually. $15,000 in JEPQ at 10.75% is equal to $1,612.50 annually. $10,000 in GPIQ at 9.81% is equal to $981 annually. $10,000 in GPIX at 8.07% is equal to $807 annually. $20,000 in SCHD at 3.73% is equal to $746 annually. Total investment, $70,000. Total annual income, $5,406.50. Blended yield, 7.72%. But here's where the magic happens. Harry doesn't spend this income. He reinvests it. This is the perpetual growth pillar. Every monthly payment buys more shares. More shares mean more dividends. More dividends mean more shares. It's the compound interest effect on steroids. Year 1, $5,406.50 in dividends. Year 2, assuming just dividend reinvestment, no growth, $5,824 in dividends. Year 3, $6,273. Year 5, $7,286. Year 10, $10,750. That's without adding another penny, without any dividend increases, without any share price appreciation. But here's the reality. These ETFs have been increasing their payouts. GPIQ's dividend grew 19.58% this year. GPIQ's grew 26.30%. Even conservative SCHD grew 8.58%. When you factor in dividend growth, the numbers become extraordinary. Harry's strategy isn't just about collecting dividends today, it's about building a machine that grows itself. Think about traditional retirement planning. You save for 40 years, then pray your nest egg lasts. Harry's approach? Build an income stream that grows faster than inflation, potentially forever. The allocation matters too. Harry's portfolio is roughly 71% high-yield income. JEPI, GPQ, GPIQ, GPIX, 29% foundation, SCHD. Conservative investors might want 50% in SCHD. Aggressive investors might go heavier on high yield. There's no perfect formula. It depends on your financial goals. But here's what Harry learned that changed everything. You don't need to wait until 65 to start collecting investment income. You don't need $1 million to build meaningful passive income. You just need the right strategy and patience to let compounding work. Every month, Harry's dividends hit his account. GP and GPQ on the 4th, GPIQ and GPIX on the 8th, SCHD quarterly on the 30th. It's like having 5 different tenants paying rent on investment properties you never have to maintain. The setup is surprisingly simple. Open a brokerage account. Fund it with whatever you can afford. Even $1,000 starts the journey. Buy these ETFs in whatever allocation matches your risk tolerance. Set dividends to automatically reinvest. Then wait. That's it. No stock picking, no market timing, no watching CNBC all day. Just systematic wealth building through dividend compounding. Harry started with $70,000 18 months ago. Today, through dividend reinvestment and appreciation, his portfolio has grown to $84,000. His annual income stream has increased to over $6,500. By year 5, if current trends continue, Harry projects his annual income will exceed $10,000. By year 10, potentially $20,000. All from that initial $70,000 investment. This isn't about getting rich quick. It's about building sustainable income that could last forever. The best part? You can start with far less than Harry. Even $5,000 split among these ETFs starts the snowball rolling. The key is starting, then feeding the machine consistently. Add $500 monthly to your positions. Reinvest every dividend. Let time and compounding do the heavy lifting. Because here's what Wall Street doesn't want you to know. Building perpetual income isn't complicated. It doesn't require genius-level intelligence or insider information. It just requires the right vehicles and patience. These 5 ETFs, JEPI, GPQ, GPIQ, GPIX, and SCHD, could be your vehicles. The only question is, when will you start building your dividend machine? Harry started 18 months ago. Where will you be 18 months from now?